Bismillahirrahmanirrahim. Assalamu alaikum. I am Sayyid Akif Shah, lecturer finance at Institute of Business Studies, Kohat University of Science and Technology. The title of this course is Intermediate Accounting, and the course code for this subject is BS 363. This is lecture number 28. The topic for today's discussion is Hire Purchase System. The outline of this lecture consists of the discussion related with the installment retailers and the accounting procedure or their mechanism for buying and selling, under which we have two systems. One is known as hire purchase system and the other one is known as installment system. The emphasis of this lecture will be on the hire purchase system and its components. What is a hire purchase system? Dear student, basically the buying and selling is done either on cash basis, where the buyer present the cash amount and receive the product, and the second option for the buyer is to purchase the product on credit basis and then to pay out its amount at the time of maturity in lump sum. Here comes a third system of buying and selling of product, which is known as hire purchase system, in which neither the customer or the buyer is supposed to pay out in lump sum at a maturity date, nor he is required to pay out all the amount of cash at the time of purchasing. Rather, in this method, the goods are delivered to the buyer immediately after their purchase from vendor, but he is called to pay the price in easy installment, which are normally periodic installment. It may be annually, or it could be semi-annually, or quarterly, or monthly installment. So the payment of whole price is not required at one time. Rather, it does not become hence it does not become the burdensome to the buyer when item is of a considerable value. By considerable value, we mean that the item which are requiring huge amount of investment, like the project machinery or the plant, or if the business is looking to construct a new plant for which the different kind of heavy machinery is required, such kind of industrial purchases require considerable amount of money. So basically in that case, the normal small kind of businesses normally go for hire purchase system to acquire the machinery for the company. So as long as the contract entered into the effect between the hire purchaser and the vendor, when the contracts enter into the effect, the first installment is paid, which is normally known as a down payment. The hire purchaser acquired the possession of the asset, machinery or the equipment, but he is not entitled to the ownership of that asset or goods until he paid out all the installment due on that asset. What are the different essential features of hire purchase system? It is none other than an installment based purchasing of any considerable value equipment for the business, which usually required to pay out the principal amount along with certain amount of interest, because the vendor is allowing the purchaser to pay out in installment, so therefore he normally requires the extra amount of interest to be paid out on such purchase. So the possession of goods is transferred to the hire purchaser. One party is the purchaser and the other one is vendor, and the condition of purchase is known as hire purchase system, in which the title of the ownership of that asset will not be shifted to the purchaser. Rather, the asset possession will be given to the purchaser to use that asset for production purposes. Second, the goods remain the property of the seller or vendor until all installments have been paid by the buyer. So the mandatory condition for the transfer of ownership is that the hire purchaser must pay all the installment due. After that, the ownership of the asset will be transferred to that hire purchaser. Third, if during the installment payment the hire purchaser defaulted on any payment, annual or semi-annual, the seller has the right to take away the good from that hire purchaser. So he can just seize the asset. The hire purchaser is not forced to complete the whole transaction by paying all the installment. Rather, what he can do, the hire purchaser can cancel the good purchased on hire purchase agreement and return that asset or machinery to its vendor or seller, but the condition will be that he will forfeit the installment he has already paid to the seller. So that installment amount will not be returned by the seller to the hire purchaser. Here comes the sixth essential feature. The hire purchaser is responsible for keeping the good in good condition. The goods or the machinery must be kept in a good condition, and there must be given due care for wear and tear of that machinery, so that or so long as they remains the property of seller until the hire purchaser is paying installment over the equipment or hire purchase goods. Till then, it is the responsibility of the hire purchaser to take care of that property or that product or that machinery. Last but not the least, as the seller retains the ownership of the good, he must get them insured against the loss or damage. So whosoever is the owner of that equipment or goods, that party must insure the loss or damage of the product. Let's differentiate the distinction. The topic is distinction between hire purchase and credit sales. Let us distinguish the or bifurcate the different peculiarities or features of hire purchase sale or purchase or sale and the credit purchase. The first point is that the ownership in the goods transferred only after the payment of last installment. So until the last installment is paid by the hire purchaser, the title of ownership will not be transferred to him. Rather, the title of ownership will remain intact or in the hands of seller. Whereas when a party is looking to purchase any product or machinery on credit basis, the ownership is normally transferred at the moment of purchase, irrespective of the fact payment is not yet paid. The second point is the remittance is made by the buyer through installment. Here the buyer is supposed to pay out installment over that purchase of goods. The payment of price is generally made in a lump sum at maturity or agreed according to the agreement. So here there is no condition of installment. Rather, it depends upon the agreement between two parties. But normally it is a lump sum payment by the buyer in credit purchase. On default, like when the hire purchaser is unable to pay out its obligation on due date, the goods will be seized by the seller. So seller has right to seize the asset and return it back or take it away from the buyer. The third condition is over in the credit purchase is on default. If the purchaser was unable to pay out its obligation, the seller cannot take back the goods, but recovery may be made through the court of law from the purchaser. Last differentiation between hire purchase sale and the credit purchase is if the buyer sells the goods before last installment to somebody else, the new buyer does not get a better title than purchaser under credit purchase. And in the condition of credit purchase, if the buyer sells the goods before the full payment of the price, the new buyer gets better title than the hire purchaser. What is the accounting records procedure for goods of considerable value? As earlier I have explained that considerable value means the material amount paid by the buyer of that asset. So cash price of the goods, in order to have the accounting records for considerable value of goods, one should note the cash price of that goods and the hire purchase charges. Now what are these? Hence we can say that each payment under this system is broken into two parts. Under the hire purchase system, normally it is divided into two parts. What are those? A part of cash value of the good, or we can say the principal amount or the cash value or actual price of the good. And the second part is interest on the unpaid amount. Since this is an installment based purchasing, so therefore the buyer is supposed to pay out interest expense or interest amount to the seller of that good on each installment. Like for example, you might have studied in financial management the topic of loan amortization. When you take loan from the bank, you have to pay out the loan obligation in number of installment over the period of time, and each installment is consist of the interest payment along with the principal amount of payment. So same is the condition in hire purchase agreement. The buyer has purchased certain equipment on installment basis and he is supposed to pay out certain amount of money as cash value, and the rest of the amount in the installment will be interest payment. Let's analyze the installments. So when a cash price is given in any example or in any numerical illustration or condition or case, higher purchase price is available and the rate of interest are also given, then what normally happens? Let's take an example. Suppose on January 1st, 1991, machinery is purchased on hire purchase system. Like installment system, somebody has purchased a considerable worth of machinery. The payment to be made was rupees 4,000 down. It means that at the date of signing the contract with the vendor, the purchaser was supposed to pay out 4,000 down payment on signing the contract and 4,000 annually for the 3 years. So in total, 4,000 multiplied by 3, 12,000 rupees, and the down payment will make up 16,000 of total payment to the vendor over the period of 3 years. However, the cash price of the machinery was or is 14,900 and the rate of interest is 5%. And the question asks you to calculate the interest charge, or what is known as over here as hire purchase charge, and as well as the cash value or principal payments. Now, how can you find out the interest to be paid each year to the vendor along with what is the principal amount? Let's do it with the help of tabulated form or table. Here it is the calculation of interest, which bifurcate the interest payment and the principal amount over each installment. The condition was cash value of the product was 14,900 as mentioned in this case. It was the cash value. You have to minus or less paid on first day. This was the contract day, and on the same day the hire purchaser was required to pay the down payment of 4,000. So therefore nothing was interest to be paid in the first year, since they are already paid the down payment and it is day first. Since interest accrued annually, so therefore the time has not passed yet, so there is no interest in the first year, and the total principal amount paid over this hire purchase agreement is 4,000. In the subsequent year, when the year completes on December 31st, 1991, the same year, the company was required to pay out once again 4,000 of installment value for the next 3 years. So similarly, the purchaser will have to pay out 4,000 installment in each year. So as mentioned in front of each year at December 31st, 1992 and then December 31st, 1993. Now we have to bifurcate the interest amount from this installment value. So for that purpose, you have to see the remaining or outstanding cash value balance. Since the cash value was 14,900 and 4,000 of first down payment needs to be subtracted from this amount, the remaining amount is 10,900, and we can see that we have to multiply the interest on the outstanding balance, which is 10,900 at the rate of 5%. So 5 divided by 100 will give you 545 as interest payment in this 4,000 of monthly installment. So just minus this interest from your annual installment of this hire purchase, and the remaining amount will set off the outstanding balance. So 3,455 was paid as principal amount and 545 was interest payment in the first installment. Similarly, let's discuss the second installment to be paid on December 31st, 1992. The cash value or the outstanding balance left over was 7,445. So once again, you have to multiply or use this formula. 445 multiplied by 5 divided by 100, and the interest will come up to 372 rupees. Now you are required to minus or subtract this 372 from your annual installment, which is 4,000, and after subtracting this interest from 4,000, the principal adjustments or payment over this purchase was 3,628. Let's discuss the last payment. Here a point to be noted that the remaining outstanding balance or the cash value is 3,817, and if we multiply 5% of interest over it, then it will come up with 190 or something around. So we have another direct system like to minus the annual installment is 4,000. So therefore directly minus this amount, which is the principal amount left over in the balance. So the principal amount has been paid out and the remaining amount will be considered as interest payment in the last year. And this is just because of a slight rounding of data and taking the approximate values in the interest. So therefore the last year's calculation for interest and the principal will be a direct method to minus the remaining cash value from the installment value if the cash value left over or outstanding is less than the installment price, which is 4,000. So we have to use this direct formula. This is the way how we can divide our installment between the interest payment and the principal payment in each year. So therefore the total hire purchase charge to be paid in this case was 1,100, and the total cash value for this hire purchase agreement was 14,900. If we sum up both these values, then the total amount to be paid in this hire purchase agreement to the vendor or seller will come up to 16,000 rupees. Now let's discuss or analyze another situation, which is situation B, where we are given with the cash price, which is 14,900 already known. We are continuing the previous example. The hire purchase price are also given, which is 16,000 in the previous example are given, but the rate of interest is not given. Then how to divide or how to calculate interest payment for each year? So here come the data. If the rate of interest is not given, the cash price or the rule says that the cash price and each installment being given, the interest will be calculated on the basis that the interest for each year will be the ratio of outstanding balance. We will see this mechanism or how to calculate the ratio of outstanding balance for the previous example in the next slide. Here it is, the cash value and the interest was 14,900 and 1,100, and this was the hire purchase price. Since the hire purchase price is given in this condition, which is 16,000, and the cash value is also given, so therefore the difference of these two amounts, which is cash value and the hire purchase price, the difference of these two is the total interest paid out to the vendor in this purchase condition. So when the data related with the cash value and the hire purchase price is given, like in this case, we can calculate the total amount of interest to be paid out to the vendor in this case, which is quite simpler. You can minus or take this value to the right hand side and minus it from this 16,000. So you can calculate the interest amount if this is unknown or X value. So with simple mathematical operation, the resultant value will be 1,100 of total interest. Now how to divide this interest charge to each year? So the rule says to find out the ratio of outstanding balance. So we knew that we had paid 4,000 in down payment in the previous example. Therefore, at the end of 1991, when the interest will accrue and to be paid out to the vendor on the outstanding balance, so the amount payable or the hire purchase price was 16,000, and since we have already paid rupees 4,000 as down payment at the date of contract, which has been paid on signing of the contract day, so therefore the remaining outstanding balance in this hire purchase agreement at December 31st, 1991 is 12,000. Similarly, at the end of second year, we have already paid our first installment at the end of 1991, December 31st, 1991. So therefore, at the date of December 31st, 1992, the outstanding balance will be this 12,000 minus 4,000 first installment as mentioned in this narration or brackets as well, paid in 1991. The outstanding balance on this date will be 8,000. Similarly, 1993, December 31st, since we have already paid this 4,000 in year 1992, so therefore the remaining outstanding balance at the end of December 31st, 1993 will be 8,000 minus 4,000 paid in year 1992. The remaining balance or outstanding balance at the end of December 31st, 1993 will be 4,000. Now it's time to make the ratios of these outstanding balance, and the method is the total interest for 3 years is 1,100 as we have calculated. The method was to minus or subtract cash value from hire purchase value. This interest should be divided in the ratio of 12, 8 and 4. So we can just find out the ratio, and the ratio says that we can just cross these zeros, and the ratio come up at the end of each year is 12:8:4. Or another way around, if we divide these ratio by 4, we will have the resultant ratio of 3:2:1. If we divide these ratio by 4, each ratio needs to be divided by 4 according to the rule. So therefore the resultant ratios will be 3:2:1. Or we can also directly apply these ratios as well, but this is the simplest ratio given for these outstanding balances. When the ratio has come up, we can now divide interest charge to each year respectively. The interest come up for first year is 550 for 1991. How did we calculate it? We can simply multiply this 12,000 by the given ratio of 3/6. Why this 6 has been taken? You have to add up all the ratios, 3 plus 2 plus 1. So out of 6 points, 3 parts were divided in the first outstanding balance. Similarly, for next year, 2 parts out of 6 were divided in the second year for calculating the interest charge, and the resultant value for first year will be 550 by this formula. Similarly, for year 2 it will be 367, and for the final year you can just simply calculate it by 1 divided by 6. So after dividing this you come up with 186. Rather than multiplying these ratios with these outstanding balance, you have to multiply these ratios with the total outstanding or interest due amount. These ratios will be applied on the total amount of ratios, not on the outstanding balance, because we are not calculating the profit, rather we are just allocating the interest amount due for each year. We have to multiply this 1100, which is the total amount of interest, because we are dividing this total amount of interest rather than to divide this principal amount outstanding. So after multiplying this 1100 with each ratios, our total interest will be divided amongst 3 years respectively. And if you add up all these 3 interest charges, it will come up to 1100 rupees. So this is the way how you are required to allocate the interest expense for each year on the basis of amount outstanding and with respect to the ratios allocated for each year. So this was all about the analysis of installment and how to divide the cash value and as well as the interest charge or hire purchase charge for each year. Thank you very much for listening to this lecture. If you have any confusion, just feel free to ask on KCMS. Another way around, you can also email me on my official email address and I'll be happy to answer your question. Good luck for the day. Allah Hafiz.